Welcome to this deep dive into Imperial Oil's first quarter 2025 earnings call.
Yep, we've gone through the call, sifted through the details.
And we're here to pull out the key insights, what really matters for, understanding where they're at and where they might be heading.
Let's jump right in. So headline numbers first.
Absolutely. What's the big picture?
Well, it was actually their highest ever first quarter for earnings, pulled in $1.288 billion.
Wow. Highest ever Q1. Okay. How does that stack up?
Pretty impressive. Up 13% compared to last year's Q1.
Okay.
And up 6% just from the previous quarter, from Q4.
So solid momentum then. What about cash?
Yeah, free cash flow was strong too, $1.15 billion.
That's quite healthy.
It is. And then they ended the quarter with a good chunk of cash on hand, nearly $1.8 billion.
Right, which usually points towards shareholder returns.
You got it. Bolstered by that, they're intending to renew their buyback program, the NCIB, later this quarter.
Okay, so record earnings, strong cash, more buybacks likely. Let's get into the details. How did they get there? Upstream first.
Sure. So upstream production overall was 418,000 gross oil equivalent barrels per day.
418K barrels. How does that compare?
It's actually a little bit below the record Q1 they had last year.
Oh, why is that?
Well, remember they had that divestment. You need to adjust for that. Once you do, it's still a really solid start to 2025.
Gotcha. So divestment adjusted, still strong. Any standouts within upstream?
Definitely Cold Lake saw really good year-over-year production growth there.
And what's driving that?
It's the Grand Rapids project continuing to really deliver.
The SIGG project.
Yeah, the enhanced solvent-assisted SAGG, ES-SIGG. It's actually exceeding expectations.
Exceeding. In what way?
Well, higher volumes, for one, but also it's helping bring down costs.
Lower costs. How much are we talking?
Unit cash costs at Cold Lake are down over $3 per barrel compared to last year.
Wow, over $3. That's significant. What's the magic there with Grand Rapids?
It's that solvent-assisted part. Using solvents with the steam, it cuts down the steam needed.
Lowers energy use, lowers cost. Makes sense.
Exactly. And the reservoir itself seems really suited to it. Better recovery, lower operating expense per barrel. Okay,
so Cold Lake is a definite bright spot.
Yeah.
What about Kearl, their Kearl Lake mine?
Right, Kearl. Production there took a hit from that extreme cold snap back in February.
Yes. Similar to what happened a few years back. 2022.
Yeah, very similar conditions. But the interesting thing is they handled it much better this time.
How so?
They'd put in new operating procedures after that 2022 event, and it seems like they really paid off materially better results this year.
Good to see those improvements working. Any other issues there?
They did have some unplanned downtime in March as well, but then April bounced back really strong, almost an April record for them.
Okay, so a bit bumpy, but recovering well.
Yeah.
Any planned stuff coming up?
Yep, there's a planned turnaround for the K2 train scheduled for May.
Okay, what's the expected impact?
They're estimating about 9,000 barrels per day impact for the full year from that. But here's the interesting part. After this turnaround, they're aiming to run that K2 train for 4 years straight.
4 years? Before the next maintenance?
Yeah, until 2029. That's double the previous interval between turnarounds.
Doubling the runtime. That shows a lot of confidence in their operations. How are they managing that?
Well, they talked about better predictive maintenance, using tech to spot issues earlier.
Proactive stuff.
Exactly. And just refining the whole turnaround planning process, being more efficient about what they do and when. It suggests, real operational maturity.
Okay. Impressive target there. And Syncrude, how did that perform?
Syncrude was pretty steady year over year, kind of a consistent performer.
No major issues.
They actually had some unplanned upgrade or downtime, but they managed it quite cleverly.
Oh.
They used an interconnect pipeline to keep the upgrader running at full tilt, basically bypassing the issue.
The benefits of integration.
Precisely. It even allowed them to produce some extra Syncrude sweet premium. Shows the value of having that connected infrastructure.
Okay. And any news on projects? That Lemming SAGD project at Cold Lake?
Yeah, Lemming B, it's getting close. They expect first steam injection this summer.
And first oil?
Later in the year. It should add about 9,000 barrels a day at peak.
Another boost for Cold Lake then. What about longer-term tech, like that EBRT pilot?
Right, the enhanced bitumen recovery technology pilot at Aspen. They hit a milestone there, successfully drilled the horizontal well pairs.
So, progressing.
Yep. Construction continues this year and next. Startup is planned for early 2027. They're hoping it's a, transformative tech for their undeveloped resources. Lower cost, lower emissions.
One to watch for the future then. Okay, let's switch gears. Downstream refining and sales.
Okay. Refinery throughput averaged 397,000 barrels a day,
Which is about what utilization rate?
about 91%. It's a bit lower than Q4 and last year's Q1.
Any reason for the dip?
Mainly some extra maintenance they did in their Eastern Canada refineries.
Okay. And product sales?
Average 455,000 barrels a day, slightly down from Q4, but actually up year over year.
Interesting. And that renewable diesel project? Still on track?
Yep, Strathcona Renewable Diesel, still looking like mid-2025 for startup.
Okay. Any more maintenance coming up downstream?
Yeah, planned turnarounds at Strathcona and Nanticoke this quarter, Q2, and then Sarnia later in the year, kind of straddling Q3 and Q4.
Got it. Now, we talked about record earnings, so presumably downstream margins must have been pretty good.
They were. They captured strong margins, crack spreads were recovering, and they really leveraged their advantages.
Such as?
Well, the integration helps a lot, right? Being close to feedstocks, close to markets, efficient logistics.
The structural advantages.
Exactly, and their market position. Plus, a bit of volatility in the market can actually create opportunities for them to get better uplift on margins.
Where they can play the market swing sometimes. Okay, briefly on chemicals. Smaller piece, but how did it do?
Chemicals earned $31 million. That was up from Q4.
But down year over year.
Yeah, down compared to last year, mainly due to lower margins overall in the chemical space and some kind of shift in their aromatic segment.
Okay, let's pull back to the financials again. Anything else notable beyond the headlines?
Well, cash from operations, if you strip out working capital changes, was solid at $1.76 billion.
Okay.
CapEx, capital spending, was $398 million. That's actually lower than last year's Q1.
Lower spending. Are they cutting back?
No, they said it's just project timing. The full year spending outlook is still the same.
Got it. And dividends.
They declared 72 cents per share for Q2, same as Q1. Consistent there.
And reaffirming the commitment to return cash, like you said, with the buyback renewal.
Exactly. Dividends and buybacks remain key parts of their capital return strategy.
What was the tone from management on the call? Especially with the CEO change coming up.
Yeah, the outgoing CEO, Brad Corson, really highlighted the integrated model's strength, praised the team, expressed confidence despite, commodity price swings.
Standard outgoing message, perhaps. What about the incoming CEO?
Rich Kruger. He emphasized consistency. No big strategic shifts signaled.
So steady as she goes.
Pretty much. Focus remains on increasing cash flow, getting the most out of existing assets.
Optimization, cost improvements.
Right. Targeted optimization, structural cost savings, looking at select growth opportunities, and really leaning on technology and that relationship with ExxonMobil.
Okay. And any comments on market demand?
Interestingly, yeah. They said they haven't seen any real material weakening in demand downstream for their products.
Oh, really? Despite economic worries?
Yeah. And they noted that product inventories, industry-wide, are still sort of at the lower end of the 5-year range.
Suggests demand is holding up okay for now?
Seems to be their view, yeah. A fairly stable outlook for their refined products.
Okay, so if you had to boil it all down, what's the main takeaway for investors listening to this?
I think it's the resilience and the efficiency of that integrated model really shining through. Record Q1 earnings despite some headwinds.
Yeah, the weather challenges.
Exactly. And Grand Rapids isn't just hype, it's delivering real cost savings at Cold Lake, which is key.
And the Kearl turnaround extension, that's a big signal too.
Absolutely. Shows operational confidence, focus on uptime, cost control. Downstream is capturing good margins, and the commitment to returning cash is obviously strong.
And stable strategy under the new leadership seems to be the message.
That's the plan they laid out. Yep. Continuity and execution.
All right. Time for our favorite segment. This is not financial advice, but let's get creative. Put on the slightly crazy hedge fund hat. What's an angle here?
Okay, let's think. Imperial's strong, integrated Canadian, what if? What if we see a major push for, Canadian energy independence?
Energy independence. Driven by
geopolitics, maybe global uncertainty, governments wanting more secure domestic supply chains, maybe even incentives pushing for more Canadian self-sufficiency.
Plausible in today's world. So how does that play out for Imperial?
Well, established players like Imperial with the production, the refineries, the distribution inside Canada, they could stand to benefit disproportionately, right?
Okay, I see the logic. So the trade.
The outrageous but plausible trade. You go long Imperial, IMO, but you pair it with buying some longer dated, out-of-the-money call options on Canadian pipeline companies.
Long Imperial, call options on pipelines. Explain the thinking.
Okay, so the long Imperial is the direct bet on them benefiting from higher demand for domestic Canadian energy. The pipeline calls are like a leveraged kicker.
A kicker how?
The thesis is if Canada really ramps up internal production and energy movement within Canada, you'll eventually need more pipeline capacity or at least higher utilization.
So pipeline stocks could get a boost down the line.
Potentially, yeah. It's a longer-term thematic bet. Depends on policy shifts, global events. Definitely speculative.
Definitely requires a specific scenario to play out. And, of course...
This is absolutely not financial advice. Purely a hypothetical thought experiment.
Understood. A thought-provoking one, though. Okay, so recapping our deep dive on Imperial's Q1, strong financials, some really interesting operational progress, especially at Cold Lake and Kearl.
And a message of strategic consistency alongside that strong cash return commitment.
But remember, this is just one quarter, one call. The energy world moves fast.
Absolutely. Always do your own homework, consider your own situation. This is just our take on the call.
Couldn't agree more. Thanks for tuning into this deep dive. Hope it gave you some useful perspective.
Catch you on the next one.